S-Corp versus LLC versus traditional corporation or even an Inc. You're trying to figure out which one you need for your new business venture. This video, I'm going to break it all down for you. We're going to take a deep dive in the difference between using LLCs versus traditional corporations versus S versus C from a tax standpoint. All right, let's get started. Okay, so here's how this whole video came about. I was watching an individual, he's an attorney, and he's actually pretty famous on the internet, teaching an event where he was telling everyone on the event that you all need an S corporation and that anybody who talks about C corporations are just basically idiots and that no one needs a C corporation unless they're a big publicly traded company. And I'm listening to this information, I'm thinking, all right, this is a bunch of BS, all right? Because you cannot take that approach that everyone needs the exact same structure for their business, because it misses a lot of the things that you should be considering when you're starting your business, and you can really hurt your ability to do many different things. And unfortunately, I've seen a lot of people take this same approach to when it comes to planning for small business owners. When it comes to creating that first business, they tend to dispense the same garbage over and over again. Set up an S corporation. You're going to save gobs in taxes. Now, what am I talking about here, and why do so many people push S corporation tax status for their entities? It's because of this. If I am making, say, $100,000 a year, and you know that's a big number, but just you'll follow with me here, and I'm running my business as a sole proprietor or a disregarded LLC, then 100% of this income is subject to FICA tax. All right. So basically, it means this: FICA and FUTA, 15.4% tax on that money, because this is active income that I'm generating from my business. It's like, oh my gosh, right out of the gate, the government just took $15,000 from me. So now I got $85,000 left over, and then they're going to throw the income tax on top of that. And by the end of the tax hit that I'm taking, I may have about $65,000 left in my pocket. So I just gave away this huge chunk of income to the Internal Revenue Service, and I don't want to do that anymore. So instead, what everyone will tell, not everyone, but a lot of these guys out there that just play this one friggin' tune will say, here's what you need to do. You need to set up an S corporation, and this is going to be really cool, guys. You're going to make $100,000, and then you're going to take a reasonable salary, and we're going to keep it small. And I've never been audited for taking really small salaries with my clients, and maybe we pay you $30,000 and we take the rest, $70K, as a distribution. And the tax magic that happens here with S corporations is that when you take out that $30,000, that's the only amount that's subject to FICA tax. So this is subject to the 15.4% tax. 15% of $30,000 is $4,500. You just saved, by making this one move, okay, what was the other one? $15,000 to $4,500. You just saved $10,500 in taxes. Gosh, who do you love? You love me because I gave you this really cool strategy, right? By doing this, because the $70,000 that comes out as a distribution, same thing, you just write yourself a check. That's only subject to income tax. It's not subject to the employment taxes, the FICA and the FUTA and those partners that you realize you've had ever since you started your first job. All right, so I get it. That's the buzz. That's what people go, oh gosh, you've saved me. Well, have you really? You know, what it takes is someone who carefully analyzes what it is you're doing and then guides you on the right path to putting together these structures. Let me show you exactly the way I do it when it comes to putting together an entity. What I want to do is I want to look at where you're starting out with. So the first thing I'm always going to talk about here, number one, is startup expense. Okay, how much money are you going to need to use to get your business off the ground? Now, why is that important? Because that's going to determine what type of entity we're setting up for you. Because when you're creating a new entity for your business, I know so many people just talk about this one entity. Everyone says, hey, I'm going to set up an LLC. Well, you may have forgotten about this, but there's another entity you can create as well. That's called an Inc., an INC, an actual corporation. But when we talk about tax status, we're not talking about the form the entity takes, whether or not it's an Inc., which is a company with shares, versus an LLC, which is a company that has membership interests. Well, actually, I misspoke. It's a corporation with shares. But we're not talking about that. We're talking about how the IRS is going to treat it for federal tax purposes. So with either of these, a traditional corporation, an Inc., or an LLC, you can elect to have both of them treated either as an S-Corp, what we just talked about, or a C-Corp, which I haven't talked about, but I'm going to tell you right now. A C corporation is not like an S corporation. An S corporation is a flow-through entity. So in that previous example, I showed you where somebody earned $100,000 in their S corporation right here. They pay tax at their individual level on that full $100,000. So this is key. It doesn't matter if you take the money out or not. You're still paying tax on that. And you're going to see why this is important, because I'm going to give you a reason why you may want to consider something else. So if I have $100,000 in my business and I leave it all in there, I pay tax on it even though I didn't pull it out. Now with a C corporation, if this wasn't an S, I would pay tax at a flat 21% on anything I'd leave inside of there. So there's a difference between the C versus an S. An S, flow through, a C, standalone. Okay, so back to the sheet here, and what do we need to look at when we're starting a business? Or maybe we already have a business and we want to create an entity for it. So the first thing you need to ask yourself is, what are going to be my startup expenses to get this business off the ground? How much of it is going to take as far as investing? Am I going to have to go out there and get education? I mean, maybe I'm taking some training courses on how to invest in real estate, or how to invest in the stock market, or how to do X, Y, or Z, whatever that is. That's going to be an expense. What type of equipment do I have to buy to get my business going? Let's assume that, you're starting this business and you estimate that out of the gate, it's going to take you $40,000 to really get to where you need to be to run this business effectively. When you add in the education, maybe the travel to the event to learn about how to run this business. So all of that gets factored in. Every dollar you spend towards this business is what I refer to as a startup expense. So when you're looking at your business, if your startup expenses are going to be greater than, let's say, $10,000 to $15,000, then the type of entity you should consider setting up here is an Inc. over and not an LLC. So if you're above $10,000 to $15,000, you want to create a traditional corporation. I would encourage you to do that over a limited liability company. Now, S versus C, it really doesn't matter here. We'd want to analyze it. Maybe an S corporation makes sense for you. So if we created a traditional corp, we could elect to treat that as an S corporation for federal tax purposes. And the benefits I just showed you with running the salary out of there, they're going to be yours to have. Maybe you want a C corporation, and I'll explain why in just a moment. But the point is in this scenario, when you have higher startup expenses in $10,000 to $15,000, the C corporation or traditional corporation over an LLC is something you ought to consider. Now, you're probably wondering, why is that? Why not just set up the LLC? Well, it has to do with what happens if your business fails. Everyone thinks that they got the greatest idea and that there's no chance that the business is going to fail. It's going to take off and we're going to do just fine. But there's always that possibility that it doesn't work out. Now, I've dealt with people before that have followed the advice of individuals like this guy on the internet that's an attorney that talks about this stuff, that set up an LLC and chose to treat it as an S corporation, and their business failed. And now they had all these money that they'd invested into running their business. Let's say they had $80,000 invested in that business, and then they have to shut it down. Well, what happens to that $80,000? Well, individuals that your CPA will tell you, well, you get to write that off. Great, I get to write it off. But what they don't tell you is that when it's an LLC that you have and that business fails and you have a loss inside of the business, you get to write off $3,000 a year on your 1040. So examples as follows. Let's assume that we have two individuals here, and wife started the business, didn't work out, and the husband's over here and he's pulling in $110,000 a year, W-2, working for his employer. Well, we have an $80,000 loss from that business when we shut it down. How much of that loss can be applied to that $110,000 to reduce their overall taxable income? Because they just lost $80K. Well, in the scenario where you set up an LLC for running your business, you'll be able to write off $3,000. That's it. And what about the other $77,000? Well, I hope you got a lot of runway left in your life because you'll write off $3,000 ongoing until you use it all up. So you can probably look at this and go, man, that's going to be 24, 22 years. That's going to take me a long time to get to that point where I collect it all. Exactly. And therein lies my point. When you're talking about creating a business entity, one of the things, it's not just S-Corp versus LLC, it's also the type of the business entity. So what I would recommend you do in this scenario, if you have higher startup expenses and it's going to take some investment to run that business and you're concerned about the possibility that maybe it's going to go down, you want to start with a traditional corporation. Now, the reason you're going to do this is that a traditional corporation will have 1244 stock loss treatment. All right, so whenever you talk to a CPA about this and they say, set up an S-Corp or an LLC, treat as an S-Corp, say, does that have 1244 stock loss treatment? And they'll say, no, it doesn't. Oh, well, I don't know if I want that. And the reason why you're going to say that is because using my same example again, which actually happened to one of our clients, we set up an Inc. for them, a traditional corp, and the 1244 stock loss was adopted when we created the entity. So this is something you have to do at the outset. We adopted to treat it as 1244 stock, the interest that they took in their corporation. When they decided to shut that business down, that $80,000 that they had in there of money that they'd invested and they'd never been paid back, that they'd lost in that business venture, we were able to flow that down to their 1040. So when I showed you that husband and wife, where the husband made $110,000, we took that $80,000 off the $110,000, so they only had $30,000 in taxable income for the year. That opportunity is only available to individuals who create a traditional corporation. So I hope you understand now when I'm bringing this up is that there are complexities that go into it since you have to consider the type of entity and how it's taxed. Now, whether it's a C or an S, that's not relevant to 1244. Both C and S are eligible to take this type of deduction. However, it's the type of entity that you set up that's very important. So the first thing I'm going to look at is your startup expenses. And so when you're setting up an entity, what you're focusing on then here, if you're concerned about startup, it's Inc. Okay, versus LLC. Higher startup expense means that you're going to want to set up a Inc. over a limited liability company. All right, so what is my second thing I look at? Growth. All right, so the next thing you want to look at is growth of business. Okay, so what do I mean by business growth? It's not just about your business taking off and you having massive success with it. It's about, do you need to keep putting capital back into your business to fund its growth, moving it forward? Because if the answer to that is yes, meaning you're going to have to keep putting the money back in, then you may want to consider setting yourself up in a situation where you have more money to put back in after taxes. And so this is where I'm not so concerned about whether or not it's an Inc. versus an LLC. If you know your business is going to need a lot of revenue or money invested in it over the next few years to keep it growing. So what we're going to focus on now here is not the form of it, it's how it's going to be taxed. S versus C for federal tax purposes. So let's go back to my example again of the $100,000. All right, so let's say we create an LLC and it's set up as an S-Corp, as the CPAs love. And we know that if I make $100,000 in this business and I pull out the $30,000 salary and then I pull out the 70K as a distribution, oh, I saved on employment taxes. Slow clap. Okay. Well, what about the fact that if you're in, I don't know, let's say a 30% tax bracket, because your wife's got some money coming in, so it's pushing those higher tax brackets. Well, $70,000 distribution is going to be taxed at 30%. That means after you pay taxes of $21K, you're going to have left $49,000 left to reinvest in that business. Because remember I said, you need to keep putting money back in your business because you're in a growth phase. So when you're dealing with the S corporation tax status, because it's a flow through, it pushes the income you make down to you at your tax rate. And if you're any higher tax rate, then you're going to be paying more in tax on that income. And so then you take that money, you put it back into your business, and you have $49,000 now left to help grow your business with. Well, in this type of scenario, when I'm talking to a client and I ask them, these questions, hey, do you plan to invest in your business and help grow it? Well, then I'm going to analyze it and say, well, maybe rather than doing an S-Corp, knowing what your personal tax rate is, how about we explore using a C-Corporation tax status? Now, a lot of times people freak out and say, well, there's double taxation there. Well, there's only double taxation if you take a dividend, and you just told me you need to keep putting money back into your business, so that's really not a concern for you. And let me show you why. So if my company generates $100,000 in earnings, and I pay myself a $30,000 salary, that leaves $70K in profit left in that corporation. On that $70K in profit, my company will pay taxes at 21%. That'll equal about $14,000 in taxes. You see, now after I paid the $14,000 in taxes, I'm going to have $56,000 left to invest. Versus S, I had $49,000. C, I have $56,000. I had $7,000 more for my business to help it grow. Now, if you just take those numbers and you 3x, 5x, 10x them, you can see these get to be quite large as you go up, especially when your tax brackets go up as well. The disparity becomes even greater. So when I'm looking at a business, if you're one of those businesses and you're thinking about that you need to keep growing, or if you're an existing S corporation and you want to grow and you're realizing, man, there's just not enough money left over after taxes to help propel the growth that I'm looking for, you might consider switching to a C corporation because you're taking advantage of a flat 21%. So you're having more money remaining in your business after you pay taxes, that you can use to invest in that business to help grow it. Or alternatively, you can do a strategy like I used, or for my business, by having it taxed as a C corporation, if I make $1 million, I only pay $210,000 in taxes inside of my company, because it effectively leaves me then with $790,000 remaining after taxes. Whereas if I took them out personally or through an S corporation, I'd pay $370,000 in taxes, which would give me only $630,000 left over for investing. So I like to make the money in the C Corp and then loan the money out to myself, and I use that to go and buy real estate. That's another video. But anyways, here's the point. When you're trying to grow your business, you ought to consider then, if you need a lot of money to grow, go with the C corporation if your personal tax bracket is greater than 21%. So if your personal effective rate between you and your spouse is getting close to 30%, you're going to find that by having that C corporation there, taking advantage of that flat 21%, you're going to grow a lot faster because you have more money left over after taxes. So that's the second thing you need to analyze. And very few CPAs perform this level of analysis. They call it deep level analysis, and they all end up at the same place, S corporation. All right, so the third thing that you need to look at, outside interest. So this is the third thing we want to look at, is what is your outside interest? Okay, outside of just this one business. So let's just not get hung up on the fact that you decided to open up a business that's going to provide consulting services, or maybe it's a nail salon, or maybe it's a logistics business, whatever that is. A lot of times people get so focused on that, which, because that's why they're coming in for planning, that they don't ask, what else do you plan to do in your life besides just run that business? Meaning, you want to go out there and invest. Do you want to buy rental real estate? Are you going to be borrowing money? These are important considerations we have as well, because the outside interest, that if you're going to be working with lenders, you want to borrow, your tax returns need to look a certain way. And the approach that, hey, I'm going to save a little bit in employment taxes, okay, by setting up an S-Corp, may not be the most appropriate choice for you, because it's going to impair your ability to grow your investments. So in this case, when we're talking about outside interest, what we're going to be focusing on, doesn't matter about Inc. versus LLC. Again, this is an S versus a C scenario here. S versus C. So where am I getting at? What am I getting at? Let's assume that you created a business, brand new business, okay? and you're also a real estate investor. You want to go out there and you want to buy property, or maybe it's not even property. You want to qualify for your first personal residence. All right. So what I'm going to do here is, let's say here we are here, husband and wife, you're married. Wife works W-2. Let's say she works for the hospital. She's bringing in $165,000 a year, and you've got this tree service business that you want to get off the ground. So you're going to be investing money. Remember, startup expenses number one into this business. So there's going to be an investment there, okay? Because you got pickers and different chainsaws and things like that, and trucks that you're going to have to invest into to get your business running. More importantly, with this type of business, since it's a startup business, and this is the other thing that's critical as well. If it's a startup business, what happens a lot of time with startup businesses when you're first starting out? Do you make money or lose money? Well, a lot of startup businesses don't make money for the first couple of years. They show losses. So if this was my scenario here and I'm starting to show some losses, okay, for the first couple of years, let's say I start this business and it shows a $60,000 loss. And I set this business up on the advice of a CPA to be treated as an S corporation for federal tax purposes. And the reason you'll be pushed down this road to do this is because they'll say, hey, you set up a flow through, you'll take your loss, you'll offset it against your $65,000 in earnings, we'll cut your taxes to be taxed at only $105,000. So great win-win scenario here by having the flow through treatment of that type of structure. Well, what this ignores is the fact that if I'm looking to go out there and buy real estate, maybe it's my personal residence, maybe it's investment property, I need to qualify for a loan. And in order to qualify for a loan to get the property that I want to buy, I have to show that I'm making money. Well, by setting my business up as an S corporation flow through, what did I do? I just cut my income, in this case, by over a third. Okay, so now I only make $105,000. So when I go into the lender and I say, hey, what do I qualify for? Well, you only qualify for whatever you make off $105,000. Well, no, we made $165,000. No, you don't. Not for underwriting purposes, because your tax returns are what we're looking at. Remember, to get a loan, you have to give them 2 years of tax returns. So now you just cut your ability to borrow. You cut your ability to buy the properties that you want to live in because you're allowing your business to dictate what you can borrow. That is a huge problem for individual business owners. Once they get the bug to buy property or they're trying to borrow money, this always comes back to haunt them more times than not, that their business is the anchor that prevents them from moving forwards because the losses that flow from the business offsets their overall income. So this is going to be a problem here because the underwriter is only going to look at this income, not the full amount. So here's a situation where if you have your outside interest is to go out and invest in real estate and you're going to be working with lenders, or maybe you want to buy your personal residence, so you know you're going to get a loan on it, then you may want to rethink this if your business is showing losses right now. And instead of setting it up as a S corporation, set it up to be taxed as a C corporation. Now, I'm not concerned, the loss that's in there, right? You're not paying any taxes on it. So this move has nothing to do about taxation for this overall business, because if it loses $60K inside of a C-Corp, there's no taxes to be paid on a loss. But what I'm focused on now is this scenario. So here's my wife. She brings in $165,000. Here's me. Okay, I bring in zero because I can't get my stuff together to make my business a success yet. So I have no money that's coming out. It's all going in. But the benefit of having a C corporation versus an S corporation is that this is a standalone entity. Okay, remember I said that earlier. It files at its own tax rate. So it doesn't flow through to your 1040. You see, with that S corporation, that shows up on your 1040. So when you have an S corp, you get what's called a K1 to show you that $60,000 loss. So when you go to borrow, the underwriter is going to see that you have a business. They're going to ask you for your P&L for your business and your balance sheet. They're going to scrutinize your business tax return, your profit, as I said, your P&L and your balance sheet, and they're going to scrutinize your 1040s because it all flows down to you. I mean, this is the dumbest thing, I think, for real estate investors who don't get this, that harm themselves and prevent themselves from buying the real estate they want, is just to always focus on S corporations. Whereas when it's a C corporation, they're not going to know what you have because the C corporation doesn't flow down onto your return. So you can lose gobs of money inside of it. When you go into the lender, you walk in, you say, hey, I want to get a loan. They say, oh, great, you make $165,000 a year. You definitely qualify for this loan. Awesome, great. You didn't know I'm losing $75,000 a year inside of my business because I didn't have to disclose that because you didn't see it. It's all hidden. So if you know that on the outside of the business that you're doing other things, right? You're going to invest in real estate like I talked about, then you might want to consider using a C corporation for your business. The second reason why I like C corporations as well in a business versus an S-Corp, because as a real estate investor, I don't like dealing with lenders who always want to look at my business. That's my business. And an S corporation, as I stated earlier, tells them you're in business for yourself. Because when you turn over your 1040 to the underwriter, they will see the K1 associated with that S corporation. They'll know how much you own in that business, and then they're going to question you on it. Whereas when you have a C Corp, that's all kept private. Okay, so outside interest. It's an S versus a C thing here in determining what is the best one. Now, one other thing too that you might want to look at when we're talking about an outside interest, again, if you're losing money on that first one up here, remember I talked about up here, maybe it's a C Corp you're setting up and you're making it an Inc. as well. All right, so now if you decide, hey, I'm never going to be able to turn this tree business around, you want to close it out, well, because you set it up as a C corporation, as an Inc., then you can take advantage of that 1244 stock loss that we already talked about. So you can take that on your personal return and write it off against your wife's income if you need to and net out the $80,000 loss. So there's lots of different things we need to focus on. The last thing I want to share with you as well is the fourth item is how much do you believe in your business? Okay, so this one is your future plans. And the future plans has to do with where you want to see this business grow to. And so what we're going to be focused on here with future plans, it's Inc. or LLC, and it's C or S tax status. You need to look at both of these. So if I was starting up a business and going forwards, I thought, hey, I don't plan to sell. If I don't ever plan to sell this business, and I'm not investing in real estate, so this isn't a concern, I would probably agree with those people out there, especially that one individual I watched. I would say, yeah, I would set up an LLC, taxes an S. Probably going to make a lot of sense for you. But if you want to sell your business in the future, okay, the number one mistake people will always tell you they made when it came to selling their business was listening to their CPA who told them to set up an LLC, taxes an S corporation. Why is that? Because when you sell your business and the money someone pays you for it, if you originally started with an Inc. as a C corporation, that's how you set your business up to begin with from the outset because you had an idea that you wanted to sell it. When you go to sell that business, the first $10 million you receive on the sale of that business is completely tax-free to you. You will save over $2.3 million in taxes if you sold your business for $10 million. It's completely tax-free. Put it all in your pocket. You know how you won't save that money? Is if you follow the advice and you set up an LLC, taxes an S-Corp, or you set up an LLC, taxes a C-Corp. It doesn't apply to you. The only way you get this tax benefit for small business stock is to set up an Inc., treat it as a C corporation. So you see, it's not as easy as everyone makes it want to be. Maybe you just work with the easy people out there. We tend to work with individuals that are a little more complicated here at Anderson, and they're looking to do more with their investing, and they realize that it takes a deeper level of analysis in deciding whether or not it's an S versus a C or it's LLC versus Inc. Those are the big questions that come up. You need to be asking the right questions. Better yet, what happens is your professional that you're working with needs to be asking these types of questions of you to make an accurate determination as to what's going to be most relevant to help you find success with your future business. Hey guys, if you liked the video, make sure you hit the like button. Drop comments down below as well. I respond to all the comments personally. And so if this intrigues you, definitely put that in there. If you'd like to schedule a strategy session with one of the advisors here at Anderson, I also have a link below in the show notes. We can set that up. It's completely free. We can do an analysis like I just showed you of your particular business, help show you what you should be looking at when it comes to putting the right business structure together for your future endeavors. Take care.